Welcome to the December 2013 edition of Advancement. 2013 has been a very interesting year, but it's been dominated by the equity market returns that have really come about over the last 12 months. It hasn't been without some volatility, and it hasn't been without some concerns that have really come through. But it's essentially meant that the weight of money that's gone into equity markets over the last 12 months has really driven the returns. This hasn't been without some degree of economic recovery that's come through, and we're starting to see that momentum actually build. It certainly has also highlighted the fact that a lot of the concerns that investors had at the beginning of the year really fell by the wayside. And even though some of those concerns did eventuate, it didn't really have too much of an impact on markets. Markets were able to recover quite quickly. Now, this isn't necessarily a theme that we think is going to continue going into 2014, but it is one that when we actually look at 2013, we've got to assess how much of it has already been priced into markets. You know, there has been an element that the expectations for greater economic growth coming through, more earnings growth coming through for a lot of companies is already priced into markets. And that's going to be a key assessment factor when we start to look into 2014. One of the key factors for 2013 has been the Fed's decision and the expectation of tapering in relation to their quantitative easing program. When are they going to actually start to slow down the buying of securities that they are affecting long-term interest rates in the US? That's a key question for investors because it does then relate to what is the future economic expectations for the US going forward. Now, this all started in May of 2013. It played out again when the Fed actually never did anything in September, when the expectation was very much there that they would. And then as people started to think about there is going to be a change of leadership at the Fed with Janet Yellen coming in, people had an expectation that this was going to be pushed out into 2014. Well, very much in 2013 at the end, in December, after the December Fed meeting, they basically did announce that they are starting to taper their program, which will begin in January. It means that essentially what's going to happen is that they are going to buy $10 billion less of securities per month coming through over the course of 2014, reducing it down to about $75 billion a month. Still talking significant stimulus going into 2014. 10 billion is not a lot in relation to the effect it's going to have, but the intention is there. All the alignment in relation to the economic recovery that they're expecting over the course of 2014 is starting to come to fruition. Now, we need to consider that. We need to consider what's going to happen in relation to, is the economic recovery going to be sustainable enough? Is the data going to come out in relation to providing that evidence? All these things are highly dependent, and those are the decisions that are going to be made in 2014, which are essentially going to be based on the data that is revealed, not necessarily on the expectations that people have.